Hey everyone, I wanted to share with you some excellent news that came out of Alphabet's quarterly earnings reports. So let's get right into these details here. First, the company continued to slow their expense growth and pace of hiring to ensure their teams are aligned with their highest priorities. Alphabet has been more prudent with their expense growth, and I've been happy to see this. I would have wished they would have done a better job with their mass layoffs. I would have preferred they focus more on reducing hiring, reducing replacing existing employees, rather than announcing those mass layoffs, because what accompanied those mass layoffs were very expensive severance packages that cost the company a lot of money. I would have preferred they would have handled that in a less disruptive way to not incur so much severance expense and so much restructuring expense. Nevertheless, I was glad to see Alphabet slow down the expense growth now that revenue growth has slowed down for the company as well. Alphabet is actively moving people to higher priority activities within the company, and they continue to optimize their real estate footprint for current and future needs. So, two things in here, let me break down each one. First, with moving people to higher priority activities, what this means is the company's focusing less on their moonshots, as they used to call it, some big high risk, high reward opportunities, and they're bringing them over closer to more practical near term activities that are going to generate revenue and profit right now and have a more clearer path to revenue and profitability in the near term rather than the longer term, higher risk reward scenarios that they were previously allocating a lot more spending to. So they've reduced that part of their investment. The second part of this statement, they continue to optimize their real estate footprint for current and future needs. And what I've been talking about a lot with companies in coming out of COVID and the lockdowns and remote work is I wish companies would implement as much remote work as possible, especially if you're a tech company that doesn't really need people to be there in person to communicate with your customers in person because of this reason here. If you've got people coming into the office, then you need an office. You need computers, you need technology to support those people, and it's a much higher expense to employ people if you're going to require them to come into the office. And on the flip side, if you allow people to work remotely, you can attract a broader pool of talent. And oftentimes, folks are willing to take lower wages if they can work more flexibly, if they can choose whether they want to come into the office or work remotely. And so it seems to me a win-win situation that many companies have failed to execute on, to capitalize on, because they want to bring people into the office because in their research they've said that people that come into the office are more productive. People come into the office are more productive according to many companies' research. But I would push back and say, okay, yes, they might be more productive when they come into the office, but are they productive enough to offset all of the extra costs you have to pay to get them into the office? And that's where I'm skeptical. That's where I doubt that there is a big enough increase in productivity to justify that higher expense to bring people into the office. So, as an investor, I've been looking at companies that are trying to get people back into the office more than they need to with a skeptical eye, with a vision of, with an understanding of why are you doing this. And so I'm paying a close attention to this and seeing how it develops, if they push back on it, if they revert their policies, and instead of doing three in the office and two at home, if they do more of like one day at the office and 4 days at home, make it more remote friendly, because I think that's a win-win situation that especially tech companies can capitalize on. The next good news that I'm going to highlight from Alphabet was Google Cloud. They continued to see growth with second quarter revenue of billion. That was up 28%, and the segment turned profitable at 395 million in operating income. Now, to put this figure, this 28% growth figure into context, Amazon's cloud segment, Amazon Web Services, in their most recent quarter only grew by 12%. 12%. So Google Cloud grew by more than twice the rate of Amazon Web Services. Now, keep in mind that Google Cloud is still much smaller than Amazon Web Services, and so if you're smaller, you can grow faster. But still, it's impressive and certainly good news for Alphabet stock investors that Google Cloud is gaining market share in this lucrative segment with very high. If you look at Amazon Web Services, that business has been able to generate 30% operating profit margins for a long time. And so it's a lucrative business model. If Alphabet can gain traction here as it's demonstrating it can, that's really great news for Alphabet stock investors. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.